Now to your community focus today. Ongoing negotiations in Washington could impact your wallet as House Democrats unveil their proposal to pay for that $3.5 trillion spending bill.
Local financial advisor Jeff Massey from Massey & Associates joins us now live via Zoom to break it all down. Jeff, thanks for being here.
Always a pleasure. Hi, Cam. Hi, Brian.
So, Jeff, let's start with some of the proposals that those lawmakers have made to some tax changes. Can you walk us through some of the headlines there?
Well, there are some big ones there. They're trying to tax and spend. It's a $3.5 trillion, what they are referring to as a reconciliation bill. And they want to target the more successful people by hitting the higher tax brackets. They intend to hit corporations. Like the corporation tax is going to go up 26% from 21 up to 26.5%. The top tax bracket for high income earners will go from 37% to 39.6%. And one that really surprised me was a surtax on S corporation profits of 3.8% as a surtax over certain levels of profitability within an S corporation.
And Jeff, you mentioned it there yourself. We keep hearing the phrase tax the rich, tax the wealthy. Will only those wealthiest among us be impacted if these changes are approved?
Most of these changes are impacting the top tax bracket and above. So what does that mean? Well, an individual hits the top tax bracket now at $400,000, where prior to this proposal, they wouldn't hit it until $523,000. So they pushed another $123,000 from the 37% bracket up to the 39.6% bracket. And for married couples, that bracket dropped from $628,000 down to $450,000. So that adds another $168,000 of income, bumping it up into the higher bracket at 39.6%. So it's pretty significant. The lower end of the brackets do not appear to be impacted. So that's the good news.
Any tips or advice that you would give to folks right now to prepare finances now, knowing that this is coming potentially?
Well, not so much specifically for these changes, but in general, to help avoid tax changes in the future, it's important to diversify. And I don't mean your normal diversification of stocks, bonds, mutual funds, exchange traded funds. I'm talking about diversification of the type of money you have. So you have pre-tax savings in retirement accounts and traditional IRAs. You have post-tax savings in Roth IRAs and 401k Roths or 403b Roth accounts. Those are your after-tax savings, and then your typical brokerage account. Now you're diversifying based on the way that it is taxed. And that, I believe, is the more important thing to focus on, especially over the next 4 years. Now through the following 4 tax years, our tax rates are very low and likely to be the lowest we'll ever see. And they will be going up in 2026. So let's take advantage of that. When we talk about tax planning to our clients to help them understand how they should consider paying today's lower taxes on some of those IRA dollars. Now, please don't do this without professional advice. It's very important to work with somebody that knows what they're dealing with these types of programs, like whether or not you should convert from a traditional IRA to a Roth IRA. The next few years may give you the best opportunity to pay the lowest taxes that are likely going to be the lowest we'll ever see as we move forward.
Planning ahead always pays off. Also curious, we have about a minute left with you today. We started the week kind of a rough hit to the stock market. Everything was in the red to start the week. What's your pitch to folks who, of course, see that and have a reaction? Talk about the volatility right now in the market.
Sure. First, our bias is towards risk reduction with our investment plans. That's step number one. It's so important to protect that downside. Now, we do expect volatility in the market. Now, we had a little bit this week. Not really a surprise, but we haven't even had a 5% pullback in almost a year, and that's unusual. So there are pullbacks called 5%, structured at 5%. A correction is at a 10% reduction. Bear market would be a 20% reduction over two quarters. So that's kind of how it's structured. We expect some more volatility because the Feds have recently talked about tapering, which we didn't anticipate until next year. Now they're talking about as early as November, more likely to start in December. And that just means they will not be investing as much money as they have been, which is $120 billion per month in mortgage-backed securities and government securities to kind of keep money flowing into the marketplace. So they will taper off. So they will invest less and less each month, and then next year, more likely to start raising interest rates again. So that is going to cause some volatility as we move forward in the stock market.
Helpful to remember that the volatility is part of it. It's normal. Jeff Massey from Massey & Associates, always appreciate your time. Thanks for joining us today.
My pleasure. Have a great weekend.
You too.